A troubled partnership, US-China financial ties, under strain. The relationship between the United States and China has always been a complex one, marked by periods of cooperation and conflict. In recent years, however, the financial ties between these two global superpowers have come under increasing strain. Written by Fareed Zakaria in Defense of a Liberal Education, the author explores the importance of a broad-based education in understanding global issues. This perspective is crucial when examining the intricate financial relationship between the US and China. The US and China share a complex and increasingly fraught financial relationship. This partnership has been built on decades of trade, investment, and mutual economic benefit. However, the landscape is shifting, and not necessarily for the better. For decades, economic ties between the two superpowers have flourished. Trade agreements and mutual investments have led to significant economic growth on both sides. The bustling trading floors in New York and Shanghai are a testament to this once thriving partnership. However, recent years have seen a marked increase in tensions, fueled by concerns over national security, economic competition, and ideological differences. News headlines frequently highlight the growing rift, and public sentiment is increasingly wary of the other side. This essay will explore the key areas of friction in US-China financial ties, examining the potential consequences and the uncertain road ahead. From trade wars to technology bans, the issues are multifaceted and deeply rooted in both economic and political spheres. The US and China are deeply intertwined through trade, investment, and financial markets. Cargo ships laden with goods traverse the Pacific, while stock markets in both countries react to each other's economic policies and market conditions. But beneath the surface of this economic interdependence lies a growing sense of mistrust. Business meetings that once ended in handshake deals now often conclude with suspicion and unease. The US government has expressed concern about China's economic practices, including intellectual property theft and forced technology transfer. These issues have led to increased scrutiny and regulatory measures aimed at protecting American interests. Meanwhile, China has pushed back against US attempts to limit its access to sensitive technologies and financial markets. Chinese officials argue that these measures are unfair and hinder their country's technological advancement and economic growth. As the rivalry between the two countries intensifies, the future of their financial relationship hangs in the balance. Analysts and policymakers on both sides are closely watching the developments, knowing that the outcome will have far-reaching implications for the global economy. The stakes are high, not just for the US and China, but for the world at large. The financial ties between these two nations are a cornerstone of the global economy, and any disruption could have ripple effects that impact markets and lives around the globe. Diplomatic efforts continue, with both sides engaging in high-level talks to find common ground. International summits and bilateral meetings are crucial in navigating this complex relationship, but the path forward remains uncertain. Despite the challenges, there are areas of potential collaboration. Innovation, technology, and education are fields where both countries can benefit from cooperation. By focusing on these areas, there may be a way to rebuild trust and strengthen financial ties. Cultural and educational exchanges also play a vital role in bridging the gap. Programs that allow students to study abroad and learn about each other's cultures can foster mutual understanding and respect, laying the groundwork for a more stable financial relationship in the future. As we look to the future, the hope is that the US and China can find a way to navigate their differences and build a more resilient and cooperative financial relationship. The road ahead is fraught with challenges, but with effort and goodwill, a more stable and prosperous partnership is possible. The race for technological dominance, semiconductors and beyond. At the heart of the US-China financial tensions lies a fierce competition for technological supremacy. This rivalry is not just about who can produce the most advanced gadgets or the fastest computers. It's about who will control the future of technology and, by extension, the global economy. The US has long accused China of engaging in unfair practices to acquire advanced technologies, particularly in strategically important sectors like semiconductors and biotechnology. These accusations include allegations of intellectual property theft, forced technology transfers, and state-sponsored hacking. Semiconductors, the brains behind everything from smartphones to fighter jets, have become a focal point of this struggle. These tiny chips are essential for the functioning of modern electronics and are critical to national security. The ability to produce the most advanced semiconductors is seen as a key indicator of technological prowess. The US government has imposed restrictions on Chinese companies' access to American chipmaking equipment and technology. These measures are designed to prevent China from gaining the capability to produce the most advanced semiconductors, which could be used in military applications or to dominate emerging technologies. This is driven by fears that China could use these technologies for military purposes or to gain an edge in artificial intelligence and other emerging fields. The potential for these technologies to be used in cyber warfare, surveillance, and other forms of digital conflict adds to the urgency of the situation. The Biden administration has continued and even expanded upon the Trump administration's tough stance on technology transfer to China. This includes not only maintaining existing restrictions, but also implementing new measures to further limit China's access to critical technologies. This issue lies at the heart of the broader US-China rivalry and is unlikely to be resolved anytime soon. The stakes are incredibly high, as the outcome of this technological race will shape the future of global power dynamics. Both nations are investing heavily in research and development, seeking to outpace each other in the race for innovation. The world watches closely, aware that the winner of this race will hold significant influence over the global economy and international relations for decades to come. Data behind bars, transparency concerns, and national security. Another major point of contention is data security and the flow of information between the two countries. China's stringent data protection laws, which require companies operating within its borders to store data locally and grant access to Chinese authorities upon request, have raised red flags in Washington. US officials argue that these laws lack transparency and could put American citizens' data at risk. The US government has demanded greater transparency from Chinese companies listed on US stock exchanges, including access to audit working papers. This demand has been met with resistance from Beijing, which views it as an infringement on its sovereignty. The escalating dispute over data security has led to increased scrutiny of Chinese companies operating in the US and has further strained financial ties. The delisting dilemma: Wall Street versus Beijing. The financial tug-of-war between the world's two largest economies has reached a critical juncture, with significant implications for global markets. The tensions over data security and transparency have spilled over into the realm of financial markets, raising the specter of Chinese companies being delisted from US stock exchanges. This issue has been brewing for years, but recent developments have brought it to the forefront of international finance. The US Congress passed legislation in 2020 that could lead to the delisting of Chinese companies if they fail to comply with US auditing requirements. This legislation, known as the Holding Foreign Companies Accountable Act, mandates that foreign companies listed on US exchanges must adhere to American auditing standards or face expulsion. This has created uncertainty for investors and has prompted some Chinese companies to seek listings closer to home. The fear of sudden delisting has made the US market less attractive for Chinese firms, leading to a shift in their strategic planning. Meanwhile, the Chinese government has encouraged its companies to list on domestic exchanges, such as those in Shanghai and Shenzhen. This push is part of a broader strategy to strengthen China's financial infrastructure and reduce its dependency on foreign capital markets. This move is part of a broader effort to reduce China's reliance on the US dollar and financial system. By promoting domestic listings, China aims to bolster its own financial markets and increase the global use of the yuan. The potential for a decoupling of US and Chinese financial markets poses significant risks to both economies and could further exacerbate geopolitical tensions. A financial decoupling could lead to reduced capital flows, increased market volatility, and a reconfiguration of global investment strategies. The stakes are high, and the outcome of this financial standoff will have far-reaching consequences for the global economy.